Yo, what's up, everybody? It is Tuesday, September 3rd. I hope everybody had a nice Labor Day weekend. Extra day of relaxation. We just had a big rainstorm down here. I like these afternoon Florida rainstorms. They're very relaxing, and then they come in intense, and then they go away. It's very nice. All right, so we had a big down day in the market today, folks. Today could be another one of these throwaway down days. And I'm only saying that because there wasn't really any particular news today. The news was, at least the news that I could ascertain was fears or concerns about a slowdown in the economy. And by the way, folks, that is real. That is a real concern. Okay, this is what I've been telling you guys, that the stock market is going to follow the economy. And up until now, we've had a lot of different factors influencing the market. We've had, Fed policy. We had the AI whole theme going on. Once in a while, you get sprinkled in there concern about economic growth. Today, apparently, was another one of these days, concern about economic growth. That could disappear by Friday. And the reason I say that is because a weak employment job report on Friday, we're going to get the August job report from the Labor Department. That could trigger the monetarist zombies again, that the Fed is going to maybe cut 50 basis points instead of 25, and we could run right back up. This is why I've been saying this for a long time. I don't like to come on here on my channel and make these videos and try to explain or ascribe a particular day's movement in the market to anything. Because it's a lot of noise. You can go up, you can go down. There are many factors. It could be a headline. It could be somebody says something. It could be some big fund adjusting their position. I try to keep you guys focused on the macro. And what I've been telling you is that, yes, the concept or the outlook of an economic slowdown, that is real, and that is what ultimately is going to be impactful for the markets. And so what I've been telling you guys is to stay focused on that. So what does that mean? As we go higher and higher into these new highs every week, you want to be raising some cash because the economy is slowing down. And the stock market is ultimately going to reflect that slowdown. We're going to get a pullback. And the extent of the pullback really depends on policy as we go ahead. Like I've been telling you guys, there's going to be more fiscal drag. Number one, from the rate cuts, which nobody understands except me. I'm telling you guys that. I'm telling you in advance that the rate cuts are going to add to fiscal drag. And then I've also been telling you guys that next year in 2025, we're going to get a bunch of new fiscal drag if it is not addressed by policy. The expiration of the Trump tax cuts, we're going to have a lower increase in the cost of living adjustments for Social Security, Medicare, Medicaid, veterans benefits, military pay, that kind of stuff. So nobody's talking about that. I'm the only one who's talking about that. So today's decline, I'm not reading a lot into that necessarily. Again, I think like by the end of the week, this whole thing could be reversed if the monetarist zombies get triggered. We need to see what needs to happen, because now we're kind of like in a static situation where we've had this year-over-year drop in net government transfers, aka the deficit, right? And I've explained it in the analogy of the swimming pool. Last year, the swimming pool water was up here. Now it's down a little bit lower because the amount of water going into the pool, while that has been actually higher than last year, the flow of water has been greater. The drain has opened up a little bit more from taxes, not because taxes have been raised, But that's just the way the system is structured, that, when the economy grows for a longer period of time, the amount of taxes that are siphoned off by just existing taxes, you don't have to have a tax increase. It just gets bigger and bigger, and it slowly starts to drain away or drag from those leading fiscal flows, the water coming out of the pipe. So the water level has gone down. But we need to get we need to get the rate cuts. The rate cuts are going to be the defining thing, the beginning of a new environment, monetary environment, and also a fiscal environment. Don't forget, because the government pays interest, and when the Fed cuts interest rates, that's going to slow and eventually turn around these interest income transfers that we have been seeing into the economy. So what am I saying? Patience is advised here. I think if you're going to, if you put a gun to my head and say, what do you think, Mike? I think the next couple of years, I don't know policy going out. I know at least next year what is supposed to happen. I just mentioned expiration of the Trump tax cuts, smaller increase in the cost of living adjustment. We get the Fed rate cuts, which, by the way, once the Fed starts cutting rates, it's going to set in motion a cycle of more and more rate cuts. I've been over that dynamic a few times. I don't want to go through it again here today. Your best bet right now. So if you ask me what's going to happen, I say without a policy response next year, it doesn't look good. It looks like we can have flat economic growth at best, and I'm even saying a good chance of a recession. Now, we got one other thing coming up. Well, we got a couple of things coming up. September 18th is the rate cut. September 16th is a quarterly corporate tax drain. Okay, so that's going to drain money out of the system. And we have, I think, October 1st, Congress has to raise the debt ceiling. So we get into that situation again, which I haven't even been really talking about. Now, we know what happens every time we get to that point with the debt ceiling. It goes right to the 11th hour, and they eventually do it. I don't know this time. I really don't know. I don't know every time, basically. I think if I'm going to bet, I'll bet that they will do it, because I think politically for both sides, it's not very beneficial or expedient if they don't do it, because they'll get blamed. People are going to be out of work, blah, blah, blah. But I don't know. And if they don't raise it, that is just going to throw another element into this slowing monetary picture that I've been talking about. So we got some interesting things coming up. I kept telling you guys it's going to get very, very interesting. And I'm excited. I keep saying I'm excited. And we're going to go back and revisit. Somebody asked me, Mike, what does revisit mean? It means we're going to go back and we're going to listen to my videos, or we're going to talk about my prior videos and how I predicted these things, okay? And these things that nobody else really is talking about. We're going to go back, or I'm going to go back, and I'm going to say, remember when I said this, that rate cuts are not going to be bullish? Remember when I said this, blah, 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 that we're going to come into 2025 with a lot more fiscal drag, et cetera, unless there's a policy response. We don't know. Anyway, it's a little bit of a short video today. That's okay. Getting back into the swing of things after a long weekend. I hope you had a great weekend. Oh, by the way, please, everybody, don't forget to like and subscribe. You guys, thank you so much. You've been doing that. It's been really helping the channel. If you've already done that, you don't have to do it again. If you haven't done that, please do. If you choose to, I really appreciate it. Thank you very much. See you tomorrow. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.